Welcome! This is the ATRAM webinar series. We are about to start in a few minutes.
Do you want to make your money work for you but find investment intimidating? Do you want to build towards a better future? With ATRAM Group's funds, you can invest according to your interests and values. Investing is now made easier and affordable. Step into your future self, invest to reach your goals and aspirations. Matching your risk appetite and investment horizon has never been this easy. Let us help you maximize your earning potential by writing the growth story of the Philippine economy and opening your doors to the international trends in the global markets. Let us prepare you for a better financial future. At ATRAM, we're making lives better through investing.
Welcome! This is the ATRAM webinar series. We are about to start in a few minutes.
Investing may feel intimidating, but once you learn a few basics, it's actually easy to understand. And understanding and using that knowledge to your advantage are some of the most important things you can do to achieve a financially secure future. Here are 5 things to consider when investing. Remember, SURE. S. Size. Know how much you are willing to invest, given that investing doesn't promise returns. Allocate money first for needs and paying off debt. H. Horizon. Before you start investing, you should determine how long you're willing to keep your money invested for a specific goal. Long-term investing, at least 5 years, is best as it allows you to ride out market volatility. The longer the time horizon, the more aggressive or riskier portfolio an investor can build. O. Objective. What are you investing for? For some, it's a short-term goal, like saving up for a car or maybe a vacation. If you need the money soon, you should invest in less volatile investments. On the other hand, your retirement or your child's college education allows you to invest in riskier investments compared to closer objectives. R. Risk tolerance. Not all people are the same when it comes to the risks they are willing and able to take. Do you prefer stable price movements without volatility? Can you stomach short-term paper losses in exchange for higher potential returns? It's best to know yourself. E. Experience. Experience is the best teacher. Actual investment experience keeps one level-headed in making decisions. Investing experience also broadens one's knowledge of different investment instruments. So, before you invest, make sure you keep these terms in mind.
Good afternoon, everyone. Welcome to this year's 4th quarter market outlook. I am JP Chong from the ATRAM Funds team, and I will be your host for this afternoon. Things are taking a turn for the upcoming quarter, since the previous quarter has shown signs of promise as the S&P 500's bull market rally defied expectations amidst inflation and the Federal Reserve's tightened policies. AI has also caught the attention of the market this year, earning comparisons to the internet and smartphone for its transformative potential to send some businesses soaring. In the Asian market, inflation remains a risk as stocks in Hong Kong and Shanghai lead losses, resulting to a dip in the market and affecting Philippine equities. Despite this, Philippine market continues to offer value and potential for growth as it is on the path to recovery post-pandemic. To shed more light on the subject, our speaker for this afternoon will be presenting a more comprehensive view of the upcoming quarter's outlook, with her investment experience and expertise through the lens of ATRAM. Through this, we hope to give you some insights into the current market outlook and prepare you to make informed financial decisions in the months to come. Moreover, We aim to strategize and create investment solutions that are suited to each client's unique goals and requirements, while assisting them in understanding the implications of their portfolios. So sit back, relax, and get ready. But of course, before we formally begin, we'd like to let all of you know that this webinar will be recorded, and the recording will be posted on all our social media platforms, so you can come back and refer to it whenever you need to. Whether you're a beginner to the world of finance and investments, or what we call a seasoned investor who wants to stay up to date with the latest investment news and strategies, we've got you covered. Our YouTube channel, that's at ATRAM Studio, has a collection of videos that features everything you need to know about finance, investments, our past webinars, and even ATRAM itself. Make sure you subscribe to our official YouTube channel and hit that notification bell to receive alerts on all your devices whenever we upload new videos. Of course, you can also find these in our website, that's at www.atram.com.ph, for a more comprehensive information on the market, finance, investments, and all the funds we provide. All of these can also be found on our social media pages. Make sure to follow us by scanning that QR code flashed on your screens. So let's give everyone here around a minute or two to scan that QR code that's found in front of them. And of course, we'd like to keep this webinar as interactive as possible. So if you have any questions at all on today's topic prior to this webinar, or you had some questions after the talk, please feel free to send them over through that Q&A tab found below your screens. This afternoon, we are privileged to be joined by an expert with over 14 years of experience in investment management and a scientist by training, earning a master's degree in physics at the University of the Philippines. Her interest in complex systems led her to seek a career in finance, and prior to the onslaught of the 2008 global financial crisis, she got her foot in the industry as an analyst and a market risk manager for the trust department of one of the top local universal banks in the country. At present, she serves as ATRAM's Chief Investment Officer and the chairperson of the firm's investment committee. She is responsible for overseeing all investment portfolio-related activities, including formulation and implementation of strategic and tactical asset allocation decisions, fund and security selection calls, and market risk management for ATRAM's discretionary managed accounts across equity, fixed income, and multi-asset strategies. Sandra is also a CFA charter holder, a member of the Board of Trustees for the CFA Society Philippines in 2017 to 2019, and a member of the Fund Managers Association of the Philippines. Come on, everyone, please join me and welcome Miss Sandra Araullo, and as she will be our speaker for this afternoon.
All right, so we're already entering the fourth quarter of the year, and what a year it's been. So I've been giving quarterly updates so far in 2023. This is the third of these quarterly updates, and let me start with just going over the lay of the land, so to speak. So how have the markets performed year to date? So on the next slide, you'll see how the different asset classes, as we cut them up here in ATRAM, have performed. So we're talking about global equities in the dark orange line, Philippine equities in the dark blue line, the global bond index in the light blue line, and the Philippine bond index in the light orange line. So it's really global equities and local fixed income that have given us some positive returns. And on the flip side, we've been getting negative returns from the Philippine equity and global bond market. So a little counterintuitive from the standpoint that it's a little unusual that it's the global equities and Philippine bonds that are giving the positive return. So it's really been US led as far as global equity outperformance is concerned. In fact, it's up until I guess the end of July, it's pretty much AI led or tech led. You know, there's been a lot of excitement around AI, and it's been price expansion or multiple expansion that's been pushing equity markets higher, not necessarily earnings results of companies. So in other words, it's just getting bought up. Nagmamahal, pamahal ng pamahal for the last first half of the year. On the other hand, on the flip side, Philippine equity markets that have been delivering on earnings, it's on track to our 17% earnings growth expectation for the year, has not been seeing it reflected in the price. So on the other hand, for Philippine equity markets, pamura ng pamura, no? It's getting cheaper by the month. And right now, we're in fact around more than 30% below the typical or the 5-year average price valuation. So I'll talk a little bit more about that later. But suffice it to say that even if 9.7% returns for global equity markets look impressive, especially relative to the other assets, it's good to take stock of the bigger picture. And on the next slide, we'll see we'll take stock of how these 4 asset classes have performed across the past 10 years. So we're just stacking here in terms of highest to lowest return for these actually 5. I included alternative assets here, but generally if you go to the last column, you'll see how the markets have performed year to date. In 2022, all markets were negative. So global equities returned almost negative 20%. And in that context, hasn't even retraced half of what it lost in 2022. And why is that? It's really because of the central bank's tightening monetary policy. So on the next slide, you'll just see a visual of how dramatic the Fed rate or the effective federal funds rate has changed in the past year. And you'll see here, compared to the previous hiking cycles, the last 11 months last 11 rate hikes, the federal funds rate target range has moved from practically 0 to 25 basis points to 5.25 to 5.5 range. So quite dramatic there. In fact, this chart is even only up to May 2, 2023. The effective federal funds rate now stands at 5.33 after a couple more hikes by the Fed. So just to clarify, this effective federal funds rate is the weighted average of the rate banks use to lend money to each other on an overnight basis. So it's really monetary policy. The higher the rates are, the less borrowing activity there will be. And this is really in connection with the Fed's effort, and in fact, all central banks' effort to rein in inflation back in the past few months. So when the Fed started raising rates aggressively to bring inflation under control, in 2022, it was all about recession, if you will recall. So actually, year to date, maraming nangyari na, but it feels like it was only in the first quarter when we were contending with the regional banking crisis in the US, and even some spillover in Credit Suisse, and these uncertainties around the banking system. Last year it was all about talks of recession. On the next slide, you'll see how the recession concern in 2022, depicted by the red line. So this is the number of Google searches for the word recession and soft landing. So what really happened in the first half of the year, it became the narrative focused around a move from recession fears to so-called soft landing. So what does this all mean? Kasi when the Fed started raising rates aggressively to control inflation, concerns started mounting around whether it would constrict growth too much and therefore cause a recession. However, the fears around this looming recession started easing as the macro data showed that the economy was showing resilience or is not slowing significantly. So this gave birth to the belief that the US economy was set for a soft landing. So basically, what's out, mild recession, and what's in is soft landing or even no recession. So on the next slide, we'll see here that this Goldilocks narrative today is one where we see inflation pressures ebbing. So that's the pink line, ano? So back in the third quarter of 2022, it reached a peak of 9% inflation in the US. Now it's under 4%. So despite this tightening of policy, you see the US unemployment rate not being affected or not tightening significant, or sorry, the labor markets are still tight, meaning people are still getting hired. There is the tightening of the Fed has not caused unemployment to spike. So this Goldilocks narrative is actually the best outcome. You tame inflation without causing a spike in unemployment. And this photo here of Fed Chair Jerome Powell I found it funny because for those who exercise or who do sport or who do calisthenics, this gymnastics exercise or move is very, very difficult to pull off. And somebody on the internet took Mr. Powell's face and put it on gymnast's body to depict how difficult of a move the Fed is pulling off at the moment. So the problem is, despite the soft landing seeming to play out, no, where the economy is not necessarily getting stifled and inflation is coming down, there are risks in the horizon that the Fed cannot control. And these are an ongoing auto worker strike in the US. There is an expected government shutdown starting on the 1st of October. And there is the scheduled resumption of student loan repayments. So once these things play out, for example, on student loans, there was a reprieve in the payments out of the pandemic. Now that it's going to come back online, all of those Americans who have student loans will have to pay at higher interest rates. So these things are can significantly add more tightness in financial conditions and can cause the economy to slow down in addition to the higher interest rate policy environment. So in short, this triple threat of that the Fed is facing can crimp growth in the fourth quarter by a little or by a lot, depending on the extent of the fallout. Again, a lot or much of it will depend on how things unfold. On the next slide, I just wanted to show how we are in for a higher for longer scenario where despite the easing of US inflation, as I said, from 9% to below 4%, there is a risk also of some reacceleration due to a combination of rising commodity prices and, again, still resilient US economy. So this has caused the investors or markets to delay the expectation for when the Fed will start easing or for when monetary policy becomes less restrictive. So that is depicted in the right-hand graph. So you'll see here, we came from the blue sloping line. So that is the expectation for where the rates, Fed rates are going to be. No, so back in 3 months ago, the expectation was the Fed wasn't going to raise anymore, and by the end of the year, it's going to start cutting. By the end of 2024, it's going to be well below 4% again. So it didn't happen, and 1 month ago, we already had the Fed raising rates back in two meetings ago. So the expectation for easing policy got pushed back, and today we're at the black line. It did hold policy rates in the last meeting, but it did guide for the possibility of one more rate hike. So I think for the balance of the year, those are the two main themes or narratives that we're watching out for. The risk that growth will start to show more cracks, or the economy will start to show more weakness out of the US, while inflation or the taming of inflation will also be challenged. And what does that mean for investors and for the portfolios that we manage? So on the next slide, I'll be walking you through. Okay, sorry, this is just a depiction of how unemployment typically hits cyclical lows just before, unemployment typically hits lows as a sign that the economy has peaked. So the US unemployment is at a 53-year low at the beginning of the year, no? So these are all just, I would say, warning signs that despite the prevailing narrative of a Goldilocks, no recession, soft landing, no landing scenario, it's still a very narrow path, and even the Fed itself is not ruling out the possibility that there will be a contraction in economic activity out of the US. Not this year, but next year. On the next slide, I'll walk you through the views that we have for our portfolios and the funds that we manage. So definitely, we think that it's going to be a grind to a slowdown. No? So two things. The first is US household savings have dropped post-pandemic, and relative to pre-pandemic levels, real consumer spending rose by 32%, while real income only rose by 6%. So the severe drop in savings indicate that the current consumer spending is unsustainable. So definitely, that's an ingredient for some slowdown. And additionally, because borrowing costs have increased to decade highs, it's going to hurt corporate margins, and this margin contraction is going to likely lead to layoffs and weaker capex spend for corporates. So the tight labor markets are not out of the woods, definitely, as part of any economic cycle following an expansion. there has to be a bit of a contraction, and then that's where we think the recession is going to play out for next year. Recession is not necessarily a bad word, no? The thing is, what's more important is that there is a contraction while inflation is well under control. It's much harder to control inflation when there is no growth. So on the next slide, it's very critical to, or the markets have been quite looking ahead to when the US Fed will decide to pivot. So it's already held off from raising rates further in the past couple of meetings. Maybe one more for the year, and then that's that. Let's see if they're going to stay on the current policy rate, or if they're going to start cutting rates depending on where growth goes. But how have the markets performed during between the last Fed hike and the first Fed cut, no? So and also 6 months after that. And on average, in the past cycles, the performance is very much dependent on many things. On average, the markets, or yes, on average, the S&P rallied about 4% CAGR. And there were 3 episodes in 2019, 1989, and 1984, where the S&P rallied by 12.5% 6 months after the Fed first cut. On the other hand, there also have been instances when the Fed cut in response to a sharply slowing economy, and the market fell by about 10%. So it's a very wide range of possible outcomes. And that's why there is a view that the US market is likely going to not rally so much from where it is today. And it's very much, again, dependent on many things that haven't happened yet. On the next slide, you'll also see here how yields are at 20-year highs, no? So that's also something quite unique about the current situation. So the elevated yields are being driven by a resilient US economy, and it actually presents a very attractive entry point for investors. So on the left-hand chart here is the yield curve of US Treasuries, how it moved from the end of 2021. So that's the dotted graph. It's upward sloping. And then at the end of 2022, the orange line where it's already negatively sloping. And today, the yellow line where short end or shorter tenured bonds are yielding you higher interest compared to long dated bonds. Historically, it's one of those things that also point to an expectation for a recession. So despite the dying down of recession expectations, especially from media or from talking heads, the markets themselves, or at least the bond market itself, still is expecting or still pricing in an expectation for a slowdown out of the US. So what we need to see happen is headwinds, particularly inflation, should we want to see it normalize further, so that when there is the slowdown that inevitably happens, there is space for central banks to cut rates, and that's where it gives us an attractive risk reward profile. So when rates are, or when interest rates are moving down, the price of fixed income bonds move up. So apart from earning on the coupons, on the nominal yields that bonds are able to give now, you can also make money from capital gains as interest rates move lower. So maybe bringing that to home, closer to home. The problem is you're not getting paid, or the slope of the yield curve is downward sloping, and you're not getting paid any term premium, meaning you're actually getting a lower interest by holding longer tenured bonds. So if you held a 10-year or a 20-year US Treasury, the risk of you're better off holding a short tenor, because you're getting paid higher interest rate, and you're not at risk of losing from yields moving beyond the 4.5% for the 10-year. So you'll see there on the right-hand chart, yields have shot up. On the next slide, you'll see how for the Philippine bond market, rates, our yield curve is still upward sloping, although it has flattened out. So it moved from the pink line to the blue line. And we think that relating it to policy rates, to the BSP policy rates, and to where inflation is, we definitely think, or the BSP has indicated that its policy is more balanced towards holding rates steady and not to tighten anymore. They have adjusted inflation projections to drop to 3.1% in 2024. So that's well within the 2 to 4% target of the BSP. And as far as the Philippine bonds are concerned, we are getting a big pickup, or much bigger pickup, for 5-year GS relative to 2019 levels. You get a 220 basis point pickup compared to going further out the yield curve. If you held 10-year GS, it's about 190 basis point pickup. So from a strategy standpoint, you're better off holding shorter, 5-year, still better than US Treasuries for sure, and holding some duration on Philippine bonds is an attractive proposition compared to global fixed income. On the next slide is our expectations for Philippine equities. At the beginning of the year, for our outlook, we did say that fair value for the PSEI is at 8,100. And this is based on where we thought earnings, or where we thought corporates can deliver on earnings growth. And we've been correct in our projections for 17% full year earnings growth. The 8,100 level, though, is also assuming 15.8 times PE, no? So that's what I was talking to you earlier about, how it's deeply discounted at 15.8 times. That's already a discount to the 10-year average of 18. We're already assuming that negative sentiment will not bring us to the past 10 years valuation that we've enjoyed since the Philippines became a investment grade credit. Even at that 15.8 discount, the market is actually pricing us today at a 12.5 times PE, no? So that's like a 30% discount to the 10-year 18 times PE average. So in other words, if the market today at 12.8 times is delivering 17%, or on track for 17% earnings growth. If there were no earnings growth, that brings us to 5,600 level for the index. And from where we are today, that's about that can't see. From where we are today, it's about 12% downside, but the upside to our fair value is about 27%. And that's again not being too ambitious around valuations. So I think the main overhang for our local markets really is still the 10-year lows of in terms of foreign ownership. In the first quarter of 2013, foreign ownership stood at more than 30%. Today, it's around 23%. So that's causing a lot of heaviness to the index. We do think that in the next couple of months, we will have a lot of data coming out, inflation and growth, and third quarter earnings season. So we want to see or we'll get a better picture of how elevated inflation from the past few months have on the on full year earnings, no? So baka may lag in terms of how it affects corporate. So this incoming earnings season is going to be quite important. Next slide, please. So here, I'll just summarize our views for the markets that we look at. We are the most constructive on Philippine fixed income. The absolute nominal yields are give a good risk reward proposition. Even if rates suffer, even if we still can't write off the possibility that there's still there can still be some movement in interest to the upside. It's more likely that we've peaked already from a rate standpoint, and that's because we think inflation would have already peaked as well. On the equity side, there is a dearth of catalyst still for Philippine equities, but considering the deep value and the upside to fair value, we have a more neutral stance there from a tactical allocation standpoint. We like global fixed income, but maybe more high quality credit and lower duration, so shorter tenured bonds. Global equities, we think that the probability of the US being able to rally from current levels are limited. We're not writing it off either. Certainly, there will be pockets that can still push the markets higher. But again, there are it will be dependent on many things that are still yet to play out, or that we probably are not even aware of yet, or it hasn't happened yet. No? So from a risk reward standpoint, it's a little the upside to the downside is a little bit overpowering any upside potential. And lastly, on alternative assets, so these are typically anything that doesn't fall under the first four asset classes, commodities and REITs and all of your other liquid alternative assets. There is still an overhang on growth, particularly actually at the beginning of the year, we said we thought that growth was going to slow in the US this year, and it will be China leading global growth in 2023. It's been the other way around. The US has shown resilient growth. China hasn't been able to deliver on expectations coming out of their lockdowns. So that's also serving as a bit of an overhang on commodity prices. So we're less constructive or on alternative assets as a result. Okay, so I guess given all of these views, no, I tried my best to simplify and to to not be so technical. I guess what's more important is how do these views, or how can you or how can you act on the views that I just shared. So I've also prepared maybe a few fund picks that it's available for our investors. So the first of these is our peso diversified income strategy. As I said, we are the most constructive on fixed income, and this fund is very much exposed, or there is a big allocation to government bonds and some income generating or dividend generating equity names. No, so on the next slide, you'll see how well it's managed by award-winning managers. And then on the next slide, you'll see the allocation. So mostly government securities, corporate bonds. It can allocate 25% to high dividend stocks and some REITs. And it'll just give a balanced and strategy that will leverage on higher nominal rates in the foreseeable future. Next fund is the Philippine Equity Smart Index Fund. So this is our rules-based beta fund, meaning it captures exposure to the market as a whole. We do use quantitative methods to get exposure in value, momentum, etc. So very rules-based, no? It's an enhanced index approach. And we like this fund because, as I said, the market is very much discounted, and the catalyst will have to come from foreign flows coming back into the Philippines. And generally, when that's the case, you just want to have beta and a low-cost strategy. The next fund is actually our Global Total Return Fund. So this exposure is on global fixed income securities. It also gives some income. The underlying target fund is the Jupiter Dynamic Bond Fund, and it's income distributing. So actually on the next slide, you'll just see a history of the dividend or the distribution. So for those whose investment objective is current income, this is a fund that should be attractive for you. So yeah, those are my top ATRAM fund picks for our investors, and happy to take any questions at this point.
All right. Thank you very much for that, Sandra. It's nice that you were able to share with us not only what's happening here in the Philippines, especially those who are Western counterparts, how the Fed I guess had their rate hikes from 13, you corrected us, 13 rate hikes since then. Also, you alluded to us a little bit on the fundamentals of finance, on when interest rates are high, bond prices tend to be cheaper. So it's really a good time for those investors of us to lock in their funds or while the interest rates are high on the fixed income market. Also, for those who want to invest on investment funds on the fixed income space, or specifically fixed income investment funds, while they're relatively cheap. So again, great stuff, Sandra. And we see lots of questions actually coming in, and I know you're excited to answer these questions. So before that, let's take more questions to our audience. Guys, we received lots of questions right now, but if I know you have more questions along the way, please keep in because we just have one more segment before we go to the Q&A portion. All right. So before that, we are pleased to announce that ATRAM has clinched several awards this 2023. ATRAM was hailed as the best investment solutions provider by both the International Business Magazine Awards and World Business Outlook Awards. ATRAM also received the most innovative fund management firm, most innovative fund offering company, and asset management company of the year, which is highly commended from the Asset AAA Sustainable Investing Awards 2023 for institutional investor, ETFs, and asset servicing providers. Just recently, ATRAM won awards for the Best Asset Manager from Citywar ASEAN Awards 2022 to 2023 and the Best Fund Management Company from the annual Global Economic Awards. These recognitions serve as a testament to our unwavering commitment in creating cutting-edge investment solutions. We believe that our unique approach in managing assets and funds has assisted our clients in achieving their financial goals. As a result of our team of experts, steadfast pursuit of excellence and innovation in the asset and fund management industry, we are dedicated in continuing to push the limits of what is feasible in the investment industry. We appreciate your continuing and, of course, confidence and support to all our clients and partners. With that, I would just like to call back Sandra. I hope that's a little bit of a segment of who ATRAM is, of what have we achieved, gave enough time to our audience right there to ask more questions. So it's our dear audience's turn to ask more questions from this afternoon, and we'll be heading over to the exciting part of this webinar is the Q&A portion. So I hope, Sandra, you are ready, as we received actually lots of questions while you were presenting. And we are still receiving more questions. So let's get the ball rolling, I guess. And I'll take this first question. So, hi, Sandra. Are US bonds now favorable as opposed to equities?
US bonds?
Bonds, yeah. So I think this question is in reference to the US fixed income securities as compared to equities in general. We can maybe allude to like global equities or maybe a little bit on the US equities, what have
Well,
you.
relative to US equities, maybe bonds are more favorable from a risk-reward standpoint. Of course, you know, you can see naman how fast the equity markets can also move, diba?
Yeah.
But the risk of a drawdown or a 10% negative returns from the equity markets are also quite possible, or I wouldn't be surprised if that happens. Whereas on the bond side, on the global bond side, or at least US Treasury side, the move in interest rates are likely finished. But that said, keep short, no? So it would be still risky to hold longer tenored bonds out of the US.
All right, thanks for that, Sandra. I think what Sandra was alluding to those also to add to this answer to this question is again, if you compare equities and bonds, like while we are experiencing right now, ngayon naka-experience tayo ng mataas na interest rates, diba? For those investors na nag-lock in na nakapag-invest na sa parang 7% in the next 5 years. If you compare to equities, yes, you have higher potential upside. There's a high probability in terms of for you to get more than 7%. But then again, in terms of the risk-reward function of finance, if there's higher risk, of course, there's higher reward, there's also higher risk alluded to it. So kung mas mabilis tumaas yung equities, it's a possibility mas mabilis din siya bumaba. All right, thanks for that, Sandra. And this next question is, let's go closer to home. So the question kanina, US bonds. Now ito naman is, hi Sandra, what will it take for foreign investors to come back to the local equity market?
Hey, that's an interesting question. Kasi we actually think that a soft landing out of the US, where there is contraction in growth, not a recession necessarily, is a good backdrop for deeply discounted markets to catch up. Nauna na kasi yung US equity market in pricing in a soft landing or a no recession scenario. It's still a little too optimistic. But if that should play out, priced in na, so wala nang pupuntahan yung US market, meaning so nagmahal na siya eh. Kailangan na mag-deliver ng earnings results ng US corporates and mahihirapan sila doon. Whereas markets like ours, mura na, may earnings pa. So,
Yes, exactly.
lahat ng nasa US markets ngayon, you can see flows, no? What we call rebalancing. So, those who have an allocation to developed markets, US markets, they may start to look outside of the US. And also to add, one thing that's headwind for our market from a foreign investor standpoint is the currency, because the Fed has been raising interest rates quite aggressively.
Yes, yes.
Yung interest rate differential na tinatawag has been causing the dollar to strengthen on a broad scale. So peso is relatively weaker. So if you're a global investor, if you put money in Philippine equities, for example, you have to account for what you might lose on the FX. And in the past year, that's something that really kept foreign investors away from our markets. But once US dollar strength tapers off, it becomes also more attractive to put money into emerging markets where the stability of the currency will not eat into the possible gains from the market itself.
All right. Thanks for that, Sandra. Great stuff. Before we dwell more into that, there's a follow-up question to that actually. So with that, do you see a recovery in the Philippine property stocks in the fourth quarter of 2023 and 2020, moving forward in 2024? So I think this is, I guess, nag-microscope na siya from not only in the local equity market, but the local property stocks here in the Philippines. So real estate, I guess, for this one.
Okay, yes and no. Yes, because I think we would I was just talking to our portfolio managers this morning. Actually, our preferred way to get exposure in the beaten down property names would be through the conglos, no? For example, we like Ali, but we prefer to use AC as a way to be exposed. I think the problem in the property space is still structural. I mean, there are still underlying reasons from for example, on the office segment, there are the occupancy is still quite low. There are reasons for why the office spaces are not getting filled up still. So the property companies need to overcome that that matter. We still think that although there will be rotation away from banks as interest rates hit a peak, we think that baka maybe it's the consumer names that will benefit first, and then later on for the property companies.
All right. Thanks for that, Sandra. Ayun, let's move on. Sige, kunin ko na lahat ng mga PH questions or maybe echo questions on this one. So I like this question. This is also a personal question of mine. So Sandra, ilabas mo na yung bolang kristal mo, because this question would be, kailan ba hihinto yung pagtaas ng inflation? So maybe you can answer. Yeah, maybe you can give us like an indication on when expect inflation to. I know it's been dwindling down slowly, but it's not as fast as we want it to be. Yeah.
So what's kind of affecting the inflation outlook is two things in the very, very short term, yung oil prices and rice prices. So those are supply side driven, and it's going to be a little tricky to forecast how the supply side can possibly intervene with the disinflation that the BSP has been able to achieve in the past months. No? So basically, inflation has come down at a faster pace pa nga than we were even expecting, because the BSP has raised rates also quite significantly. A lot of the second round inflation, or the inflation that we were importing through the currency from the US, they were able to get that under control. But that said, again, there is a risk that you see a little bit of a blip, or maybe we're underestimating the next inflation print. We have the next inflation print in October 5.
Yes.
So should there be a higher than expected print, that probably your bond prices may react to that news, pero not a whole lot. We don't think it's going to be the balance of risks. You'd rather be invested than trying to time getting into the market based on economic data. Kasi as in the bigger scheme of things, rates have moved higher, inflation is coming under control, and it's going to be within the 2 to 4 target band by next year.
All right. Thanks for that, Sandra. I see lots of questions coming in. For this next question, I'll take this one para makapagpahinga naman si Sandra. Does the Peso Diversified Income Fund give out dividends? So Sandra has alluded to this earlier. The Peso Diversified Income Fund. So she has mentioned na yun nga, that fund has exposure on government bonds, so also corporate bonds, preferred shares, and REITs. So to answer that question, yes, it does give out dividends every semi-annual. So that's every 6 months. And we actually paid our last semi-annual income payout for the Peso Diversified Income Fund, and that would be a little over 4% for that one. So as you can see, you're not only experiencing capital appreciation by investing on that fund, but also you have received income every semi-annual. All right, so sana kapahinga ka sana ng kahit konti kasi medyo may mga questions pa tayo, and I like this next question kasi iti-test talaga nito yung I guess free advice ito for this person who asked this one. I'm an ATRAM investor in the US multi-asset income feeder. So this person has exposures on the multi-asset space in the US markets by investing on our multi-asset income fund. Would you place it at the global total return bond feeder? So tanong would be, should I move my US multi-asset investments to the global total return bond feeder, which is a global fixed income investment? Very interesting question, Sandra.
Dollar ba?
Dollar, yeah.
The fund is dollar denominated.
Yeah, dollar. Yeah, that's dollar. Yeah.
Yeah, I think so. Actually, baka better pa combine the total return bond with the global tech fund. Maybe a smaller amount. So let's call it 20%, put it in the tech fund, 80%, put it in the bond feeder fund. So you retain your dollar denomination, and you're able to be more precise on the sector exposure in the US, because as I said, the mahal na ang stock sa US, and the question remains if they can deliver on growth. And we know that from broadly speaking tech, although marami pa yan, semiconductor, blah blah blah, the Fidelity Global Tech Fund, which is the underlying fund of the ATRAM Global Technology Feeder Fund, is really well managed fund, can be defensive, and so you're still capturing the upside from an earnings growth standpoint, and you're adjusting a little bit the exposure from the multi-asset, the US multi-asset income. Parang 60% is in equities, so you would have already enjoyed the move in US equities in the first half. Congratulations.
Yes.
You can, it's a good time to adjust that exposure.
Thanks for that, Sandra. Great stuff. Kung sino man nagtanong nito, nakalibre kayo ng isang portfolio review sa CIO namin na si Sandra. All right. Since Sandra, I like this question. It's a good transition. You mentioned the ATRAM Global Technology Feeder Fund. So with this, Sandra, can the tech rally continue?
Okay. Before this webinar, tinanong ko yung aming multi-asset portfolio manager on his investment thesis for adding the global tech fund in our discretionary strategies, no? So we actually were quite conservative at the beginning of the year kasi nga we're coming from a recession narrative eh. Plus the AI driven rally is more sentiment driven and a lot of speculation actually. So we had to kind of we didn't want to put investment in tech just because we're FOMO or we're trying to naghahabol kami. So but we did the work and the due diligence, and the reason why our multi-asset manager added global tech fund exposure, it's because we expect EPS growth, so earnings per share, to register in the mid-teens for the next 3 years. Right now, earnings growth is where is it? Very low, no? So practically 2% this year. So from 2 to 15 in the next 3 years, that's at least that can support the high valuations. What else? We also are using that exposure to balance off the tactically underweight global equities allocation that we have. So it's higher beta, meaning it will capture market movements more dramatically. But I think take away the up and down or the volatility. If you take a 1, 2, 3 year horizon, we definitely think that tech has a way to go. In fact, it's a very, I mean, you can say now we're in this fourth industrial revolution, no? Insofar as the developments around AI, Gen AI. I know it sounds really gas-gas, pero it's actually quite promising, and after the hype has kind of died down a little bit, there is some value to be had in that space.
All right. Thank you, Sandra, for that. Really great stuff. I know there are lots of questions I see here, but unfortunately, that's all the time that we have for questions. But of course, as I've showed you earlier, guys, you can join our Viber community group so you can ask questions here to be updated on the latest trends on the investment space. But before we end and before we go, Sandra, do you have anything else to say to us, or any parting words to us that has joined this fourth quarter outlook?
I think that I always say this. It's better to spend time invested, or time in the markets is always better than trying to time the markets. Diversification is the only free lunch left in finance, so let's take advantage of that. And I'm happy that more and more Filipinos are getting educated and are and ATRAM is very much committed to that, no? So we want to see every Filipino investing in their dreams, and so I think it's like 10 years from now, I'm confident that those who put their money to work will enjoy the benefits. It's quite messy. Markets can be really confusing, up and down, but we always try to not lose the forest for the trees. Um, Equity markets are really cheap right now. Philippine equity markets are really cheap right now. Even if you put money in at the end of August and it went down to 6,000, uh in the span of a week it's back up to 6,500. So the bumpiness will be there. The best thing to do is to know what you're investing in, and we're here to help. We're here to match or give you strategies and products that will fit your investor profile and your objectives and your risk. So ano lang, I hope that our clients and our listeners will continue investing and trusting ATRAM to deliver you product and to also share with you insights and to be on top of things as it relates to your wealth and your investments.
All right. Thank you very much for that, Sandra. So once again, would like to extend our gratitude to you for providing us with great insights for this webinar. And of course, to you, our dear audience, for your active participation, of course, for these lots of great questions that we received. We sincerely appreciate you for taking the time to join us today. ATRAM Prime provides us the access to a wide range of investment options, allowing you to customize your portfolio based on your goals and risk tolerance. With a commitment to a long-term growth, ATRAM Prime's expert fund managers employ proven investment strategies, guiding you towards building wealth that withstands the test of time. For more information, check out the following video.
Good day. ATRAM is the leading independent asset and wealth management company in the Philippines. If you are interested in investing in ATRAM Prime, download the app in the Apple App Store or in Google Play Store. You can also visit prime.atram.com.ph to know about ATRAM Prime. If you have other questions, you may fill out the contact form on our website or send an email. We hope this helps. Thank you.
All right, as what Sandra has mentioned in terms of the financial literacy, ATRAM really takes pride that we share these with our partners and with our clients. So whether you're a beginner to the world of finance and investments, or what we call a seasoned investor who wants to stay up to date with the latest investment news and strategies, we've got you covered. Our YouTube channel, that's at ATRAM Studio, has a collection of videos that features everything you need to know about finance, investments, our past webinars, and even ATRAM itself. Make sure you subscribe to our official YouTube channel and hit that notification bell to receive alerts on all your devices whenever we upload new videos. You may also access our official social media pages by scanning that QR code found on your screens. So let's give our viewers like a couple of seconds. Once you scan that QR code, you have access to our YouTube channel, Facebook page, Instagram, and even LinkedIn. Once again, we extend our deepest gratitude for your participation this afternoon, and we'd like to wish you and your loved ones continued health and safety. I'm your host, JP Chong. Good afternoon, everyone, and we hope to see you all in our next webinar. Have a great day ahead.